Okay, so I wanted to give you a little guidance on the mastery problem. It says Christy Williams offers family counseling services specializing in financial and marital problems. A chart of accounts and a trial balance taken on December 31st follow. So on page 175 in your textbook is the chart of accounts. So these are all the accounts used by the business. On the next page in your textbook, they give you the trial balance as of December 31st. Now, not all of the accounts in the chart of accounts have a balance in the trial balance. You are going to use this to prepare your worksheet. And remember, the first step in the worksheet is to prepare the trial balance. Well, the accounts and the balances are given here for you. However, when you prepare that trial balance, make sure that you include every account. Include every account in your trial balance. For example, depreciation expense, computer equipment. Depreciation expense, computer equipment is not on this trial balance. It's not down there because it does not have a balance yet. So be sure that when you prepare your trial balance in the worksheet to include every single account title, even if it does not have a balance. So you'll just leave that line blank as far as the balance is concerned, but you need to include every account because there may be an adjustment that affects an account that is not on this trial balance. Okay, so that's the first tip that I wanted to give you. Include every account, not just the ones listed here, every account. Okay, and then I wanted to talk with you a little bit about these adjusting entries. So after you have your trial balance, and of course this is what it should balance to. So after you've prepared the trial balance on the worksheet, the next step in the process is to enter the adjustments in the adjustments column. So here is your information on the adjustments, and I just wanted to discuss these with you. So the first one says office supplies on hand at year end amounted to $100. So office supplies on hand. Remember, the adjustment is for the amount used. This does not give you the amount used. This gives you the amount on hand. So to determine how much is used, you're going to have to take what you started with, the $700, and you're going to have to subtract what you still have, the 100. So 700 minus 100 would give you the amount of supplies used, and so then you could make your adjusting entry. Okay, the next adjustment, B, says on January 1st, Williams purchased office equipment that cost $18,000. It has an expected useful life of 10 years and no salvage value. So we are going to have to calculate depreciation here. Okay, so let's review. How do you calculate depreciation? There are two steps. The first step is that you must calculate, or you must determine, depreciable cost. Computer is not cooperating. Depreciable cost. And that equals the original cost minus salvage value. So according to our textbook, the original cost was $18,000 and there's no salvage value. So $18,000 minus 0. So our depreciable cost is $18,000. The second step in calculating depreciation is to take that depreciable cost and divide by the useful life. That's going to give you your depreciation. So we've already calculated our depreciable cost is $18,000. Looking back, our useful life is 10 years. Okay, so we need to see, how long have we owned this? Well, we purchased it January 1st, and now it's December 31st, so we've owned it for a year. So we will divide by years rather than months in this problem to get our amount of depreciation. So 10 years equals $1,800 in depreciation per year. So that will be the amount of your entry for B. So the amount of depreciation for the office equipment is going to be $1,800. So you will debit, see these accounts are not on here, we're going to debit depreciation expense office equipment, and we're going to credit accumulated depreciation office equipment. You will do that on your worksheet. Okay? The entry C says on July 1st, Williams purchased computer equipment costing $6,000. It has an expected useful life of 3 years and no salvage value. Assume that Williams computes depreciation to the nearest full month. Okay, so we are calculating depreciation again, this time for the computer equipment. So the same steps are necessary. So I'm going to erase this. So our first step is to determine the depreciable cost for this equipment. So for depreciable cost, we have to know the original cost, $6,000, and we have to know the salvage value, no salvage value. So 6,000 minus 0 is going to give us a depreciable cost of 6,000. Okay, then to calculate the depreciation, we take this depreciable cost and we divide by the useful life. So if you remember, we read that the useful life is 3 years. Okay, do we need to use years or do we need to use months? How long have we owned it? We bought it July 1st. So July, August, September, October, November, December, that is 6 months. That is half of a year. So let's divide by 3 years and then we'll know that our depreciation is 1/2 of that. So useful life is 3 years. 6,000 divided by 3, the depreciation is $2,000 per year. But we haven't owned it a year. We've only owned it for 6 months. That's 1/2 of a year. So we need 1/2 of that. So our depreciation for entry C is $1,000. So for entry C, this is computer equipment. So we will debit, we're going to debit depreciation expense computer equipment, and we're going to credit accumulated depreciation computer equipment. Again, that's why you had to make sure that you included every account on the chart of accounts, because if you just included these, you would not have the accounts you need to make these adjusting entries. Okay, and then the last entry says on December 1st, Williams paid a premium of $600 for 6 months of insurance. So he paid for that on December 1st. We recorded prepaid insurance at $600. That $600 is still sitting on our books. However, now it's December 31st, so we have used up 1 month of that insurance. We have to calculate how much insurance has been used. Okay, we paid $600 for 6 months. So if we divide 600 by 6, that's $100 per month. And if we bought it on December 1st and now it's December 31st, we've used 1 month. And so we've used up $100 of insurance. So that will be the amount of that adjusting entry. Okay, so hopefully with that information you will not have any problems. You will enter the adjustments and complete the worksheet and then journalize the adjusting entries.